Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, and my colleague Victor, who is going to join us shortly. Thank you so much for your patience. For those of you who are watching us live, please make sure you ask us questions in the questions box and in the chat window. For those of you who are watching a recording of this, please consider joining us live next time, so that that way you can ask us questions and the webinar is more interactive and more appropriate for your needs. Now, today's webinar is obviously going to be about live charts. We're going to start off by looking at a few macro events that are going to happen this week, specifically the US Federal Reserve meeting. Before we do that, please have a read through the risk warning. I'm going to help you with the first paragraph. So here we go. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information related to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Very quick reminder then. So this webinar happens every Tuesday, 11:30 London time. It's a mixture of technical analysis and fundamental analysis. This is the key events for this week. I prepared a week ahead report, which I normally do on a Friday for the upcoming week. So if you go to the website, market news section, you will see the latest week ahead report. And in this one, you can see that we've got a few things coming up this week. UK jobs came out this morning. Retail sales in the afternoon from the US is going to be important. We also have PPI, Producer Price Index. So right now the focus is on inflation. Last week, remember, the US CPI came in at 5%, really strong. And that has raised speculation that the Federal Reserve may have to start at least talking about the timing of their tapering of bond purchases. And they might do that at this FOMC meeting, which is happening on Wednesday. So ahead of this FOMC meeting, the markets are, well, stock markets have been rallying really sharply, suggesting that investors are not really too concerned about tapering yet. But the dollar has come back. So there's been kind of mixed response in the markets.
So one of these markets is wrong, right?
Right, yeah. Which one do you think is wrong? Obviously, the equity.
Well, I think it's the currency market that is wrong.
Right.
I don't see the Fed tapering.
Yeah.
There are no inflationary pressures according to them. We all live in a bubble that is different than the Fed's bubble.
Yeah.
Prices are rising on the street, left and right, everywhere around the world, if I'm not mistaken. I mean, correct me if I'm wrong. But I bet the same thing is happening in the UK, especially with Brexit. But what's really driving the Fed's decision here is the fact that there is so much debt in the system that any tiny increase in rates is going to basically roll over the recovery, and we could be back in the doldrums very, very soon. So this is what the Fed is thinking. I think, like, this is my take on what their thoughts are. So what's going to happen tomorrow is going to determine the next big leg in the dollar, and I think in stocks as well. I don't see. I just don't see them talking about tapering at this point in time, and that's
I kind of agree, and to be honest, the reaction we got from the CPI last week, everyone was waiting for CPI and to some degree the European Central Bank meeting. Neither of those events cause too much of volatility in the markets. Yes, the markets moved a little bit, but not too much. So I reckon this time, FOMC comes out. I think I kind of agree with what you said, and I still think that the dollar is going to drop because it's so close to those yearly lows. Just give me 1 second, Victor. Yeah, you can take from.
Yeah, sure. There is from a technical perspective, we're seeing the dollar kind of attempting to rally at these levels, and it's been very successful in doing so against the Japanese yen. Not that successful against the British pound, for example, but still, like over the past couple of days, the dollar has moved higher, and we have observed this kind of key level in the dollar index at 90.50 now. That is holding the upside, but it's from a technical, just from a technical perspective, it looks like it has bottomed out. So again, like, that this setup changes in one day. So basically,
absolutely, yeah.
The moment that the market realizes, oh, okay, we trapped some dollar bulls, and now it's time to clean them out, and that's going to happen. So
yeah, I mean, the dollar,
whether it happens depends on the fundamentals.
Yeah. As technical analysis is obviously, it's important.
Dark magic.
Yeah, but the markets are always driven by fundamentals, right? Yes, they move in a technical way, which is why you need to know technical analysis in order to trade. But there's always a reason for the markets to be trending in one particular, direction, or when it's going sideways. And right now it's going sideways because of people waiting for the FOMC. Now, going back to the economic calendar, we do have a few other things. Remember, UK CPI is going to be important for the pound. Headline CPI in the UK is expected to come in at 1.8 in May, after rising to 1.5. So it's getting closer to the Bank of England target, and soon the Bank of England will run out of reasons to keep monetary policy so loose in the UK. So that could, if inflation continues to rise, put strong pressure on the pound. The pound did actually rise to a yearly high a couple of weeks ago, before pulling back a little bit, along with the general dollar strength. But yeah, I mean, the pound is still quite strong, and if we see further strength in UK data, then especially in CPI, then speculation will rise about kind of at least tapering of QE in the UK, if not a rate rise. On Thursday, we have employment report from Australia, very important for the Aussie dollar, which has been going sideways. So we could see a breakout in the Aussie on Thursday, because by then we will have also had the FOMC meeting. Two other central banks at the end of the week, Swiss National Bank and the Bank of Japan, they are not going to do anything, are they, Victor?
No, I don't see them doing anything, except reiterating that they're strongly committed to their dovishness.
Yeah.
To keeping rates as low as possible. Yeah, this is something to think about. Like the Japanese central bank has kept rates so low for so long.
Yeah.
And yet the Japanese yen hasn't really been taken to the doldrums yet. I mean,
on the daily it's rising, but if you zoom out, it's
if you zoom out, it's pretty pretty stable, actually. Which is what they would want as central bankers. Like central bankers hate volatility, and this is why they adopt the policies that they do. And for now, it seems to be working in Japan. However, at some point in time, that might change radically, and then we're going to enter probably into a new era in terms of.
So the Bank of Japan is one of the most dovish central banks out there right now, right? And which is why the US dollar has managed to.
Even the US dollar, which has been on the back foot against other currencies, has managed to eke out some gains over these past couple of weeks.
Indeed. And so that means that if you want to avoid the dollar because of the upcoming FOMC meeting, perhaps take a look at a yen cross like Euro yen, which is my favorite right now. It's been trending really strongly. If you look at current price action, it's kind of taken out this, it's testing the upper resistance of this channel. And a breakout could see it go to a new high for the year. So the trend is really strong in the Euro yen. And, this is a bull flag continuation pattern. It does look a lot, overbought, but sometimes trends can go on for ages before they reverse. And right now, the 21-day exponential is providing good support. Other yen crosses like the pound yen, this continues to trend in the direction of the in the upward direction. It did attempt a breakout this morning from this bull flag or whatever you call that continuation pattern. So far, the breakout has failed. So it's worth keep an eye on this ahead of UK CPI tomorrow. But the day before, the pound yen created this nice bullish engulfing candle at the still rising 21-day exponential, which is a strong indication that it wants to go further higher. So far, it's looking bullish. I don't think it's topped out yet, but when it does, we will know, because price action will tell us, right? So right now it's making higher highs and higher lows. There's no point in fighting that trend until the charts tell you otherwise. But going back to the majors, let's talk about the euro dollar first of all. I mean, the euro dollar is probably one of the most difficult currencies to trade right now. It continues to frustrate both the bulls and the bears alike, right? Along with the dollar strength in recent weeks, the euro has come back down in part because the European Central Bank is still quite dovish. That's been reflected in price action with the euro dollar breaking below the 21-day exponential. Overall, I don't know if it has topped out. A lot depends on the FOMC. I continue to think that this is not the end of the euro dollar bull trade yet. I still view this as a consolidation rather than a reversal, because it's just the way it's kind of drifting lower. It's not going down really aggressively to make it look like it has topped out. So
any attempt to sell off the euro against the dollar has been met with more and more demand. At higher and higher points, like we had the 117 level that held in at the end of March. Then by April, we were holding above 119, 1950. Then in May, above 120, 2050. And now we're kind of constrained by the 121 area. So whenever the euro drops below 121, some buyers emerge and push it higher. The only thing that I can think about that is still a positive for the US dollar is basically the carry trade. Because the yields on the US 10-year are still way higher than they are in Europe, so you can make some relatively low risk spread on that end.
Yeah. So the chart that I've just pulled up, it's exactly what you're talking about. This is the blue line is the spread between the 10-year German yields and the 10-year US. So when the spread falls, typically this should lead to euro weakness. But when the spread rises, it should typically lead to euro dollar strength. And in recent times, you know, it's kind of tracked it very closely. If I yeah, see that?
Yeah.
Interestingly, though, the spread has broken out in the favor of the eurozone in recent times.
Well, yes, this is. Albeit that was like really short term, but
it was short term.
Let's see.
I mean, this is the 10-year US, right? It's consolidating inside this.
Yeah.
Could be a bull flag, a bear channel. I don't know.
Yeah,
but it's falling below 150.
It can be anything at this point in time.
At this point in time.
So yeah, the tomorrow is going to be a big day. I think. I think that it can finally unleash a trend move.
Yeah.
In the currency market, in the bond market, stocks. I don't know. They're already in a trend. So.
Yeah. I mean, if you go to equities now. Look at a few equity indices, and starting off with the S&P 500, it hit a new all-time high yesterday, and index futures have risen to new record high. So, I mean, you know, like equity markets are telling us that investors are not worried about tapering, and so should the FX markets be worried? The thing with FX markets is it's always relative, right? So you're looking at two currencies, one economy against another economy. And on that basis, you know, for example, if you look at the pound, we've been pound against the dollar. The UK economy has come out of lockdowns earlier, and it's rebounded stronger than most other economies, but not against the US dollar, not compared to the US economy. Against the dollar, even it has managed to rise because people expect the US dollar to, you know, as a currency, as a reserve currency, to remain undermined because the Fed is going to keep its policy loose, whereas the Bank of England is expected to soon start tightening its belt. But in the equity markets, it's you know, it's not just the Federal Reserve that's going to keep its policy extremely loose. We have so many other central banks that are still so dovish. The European Central Bank, for one, Bank of Japan, you know, you name it. So there's going to be lots of liquidity flying around in the global equity markets, or financial markets, I should say. And all of that cheap central bank money is going to find its way into all sorts of assets, including, as it has been the case, equity markets, gold, silver, which is why I continue to think that asset prices are still going to rise further, because I don't think we're there yet in terms of tapering QE and raising interest rates.
Let the madness continue.
Indeed. So the S&P has broken above this high, this red level here. This was the previous record high.
Yeah.
Look how many signals we got in the last so many days that it was going to break higher. One of my favorite ways of anticipating a breakout above a major high or a recent high is by studying price action below this. For example, if we get really close to a previous high, usually it breaks through. Also, what I like is when bearish looking price action fails to bring out the sellers just ahead of a major high, and the opposite near a major low, right? So for example, in here, we had this inverted hammer candle, but there was no downside follow through on the subsequent days. You know, that was a big telling that it wants to go higher. we saw so many doji candles here, 3 of those, no downside follow through. So it's the lack of it's when something does not happen when technicals tell you that it should, is when you can get a really strong feeling about something, which is why I was talking about a breakout in the S&P in my previous webinar.
So what do you make of the Dow underperforming? If you can
the Dow, where's the Dow?
a bit lower. Yeah, there you go.
Well, I don't know. I mean, so technology stocks have outperformed in recent times, right? If you look at the Nasdaq has broken out.
Most certainly, like the lower the yields go, the higher the technology stocks go.
Indeed.
Basically, that's how it goes. It looks like they're setting up for a melt up from here, to be honest.
Indeed, yeah.
I wouldn't be surprised if we hit 15,000 by the end of next month. But I'm not forecasting it by any measure.
No, of course.
Just saying that it could happen. So
we got this one spot on as well, didn't we, from last webinar when it had just broken above this resistance area. We said that back into this zone could lead to a break to a new record high. And lo and behold, it's there. So as you mentioned, yields have fallen, which is why the technology stocks have risen. And to answer your question, S&P has technology stocks in the index, big technology companies like Apple and so on, whereas Dow, it doesn't, right? So there's been a bit of rotation, in other words, into growth and technology stocks in recent days because of a few central bank heads coming out and saying that QE is going to remain in place for longer than expected.
Yeah, and are we on the precipice of the growth rotation ending? I mean,
I mean, that could be an interesting.
Could we argue that most of the reopening has already been priced in, and these kind of old school value names are basically priced to perfection right now, with the expectations that everything is going to return back to normal? Something that I'm pretty skeptical about still.
Maybe I don't know. It's an interesting question. I mean, it's a rhetorical question, but we will see.
Sure.
So look at the FTSE though. The FTSE has broken out. I mean, there's lots of value stocks in the FTSE 100, right? The FTSE is one of the most boring indices out there. No doubt about that. It hardly moves. But when it does move, you got to take notice. We were talking about this breakout for several weeks, and it didn't happen until last week when it finally took out this trend line. And so far, it's holding above, which is indicating that perhaps the rotation out of value stocks is not done yet. I mean, the rotation into value stocks is not done yet. That we could see.
What about the DAX?
What about the DAX? Look at that. It followed the script quite nicely here. Tested support, the previous resistance area, bounced from there, broke the previous record, and it's holding. So I think from here, because of the fact that the European Central Bank, told the market that they're not going to taper anytime soon, and the fact that the euro has weakened a little bit, which makes eurozone exports more attractive for foreign demand. This has allowed the German DAX and other European indices to break to new records. And I think concentrating on the long side until the charts don't make sense is the way to go in European names. If you look at the French CAC index, very strong. It's been melting up for several days. And it's getting closer to the 127 extension. Let's see where the French index is in terms of historical levels. It's broken its pre-pandemic high, which was at 6,100, whereas the FTSE 100, for example, hasn't. See that?
Well,
the FTSE has
if there is any impact from Brexit, you can see right here.
Indeed, absolutely, yeah. This could be it, right? But maybe we will see in the UK like a strong recovery in the second half of the year. Who knows when things open up fully, and that could propel the UK 100 to above the pre-pandemic highs.
Speaking of that opening, I heard that it got delayed once again.
Absolutely, yeah, it got delayed by a few weeks, and I mean it's not. England was already like mostly open, you know, like it was just a case of social distancing in restaurants and in cinemas and a few other places. But yeah, I mean, it's going to impact the economy, but I don't think it's going to be too significant of an impact. So hopefully.
Do you have AMC theaters in the UK?
What's that?
Do you have AMC theaters in the UK?
Maybe we do. I don't know. I haven't come across one.
Yeah, it's a crazy stock that has been become very popular in recent weeks because of the way it moves. Contrary to any fundamentals, the company keeps issuing equity, diluting shareholders, and the stock keeps going higher. So basically, this is
meme stocks that's been
if there is any illustration as to the distortion in the markets that was caused by central banks, this is where it is. Basically, we're seeing a systemic outperformance of a stock, while the money from shareholders that the company is raising at every sale directly goes to the bondholders that are basically holding the company's debt, and shareholders are basically not secured in any way, while bondholders, in case of a bankruptcy, they basically get all the money that the assets that the company has remaining. So yeah, how long is this going to last? We don't know.
Yeah, indeed, we don't know. It's interesting nonetheless that you have things like this happening in the market. You know, it's unbelievable, right? It's totally unbelievable. But you know, this is not the only crazy thing we've seen recently, right? Dogecoin.
Still alive, still hanging around.
Still hanging
30
there.
cents.
Not very well though. It's petering out, isn't it? The big.
Well, yeah. If you look at this, it looks like a giant head and shoulders, actually.
But this is the left shoulder. This is the right, yeah.
Yeah. How does this conclude? Well, probably with somewhere close to zero. I don't
know. Bitcoin has been doing okay-ish recently. It has broken out above the trend line. Finally,
yeah.
It failed a few times, but this time it's broken out cleanly.
It broke and then stopped at the 40,900 level, making a double top there. So
a potential double top.
Yeah.
It's I think the fact that it's spent so long in consolidation and now that it's broken out, obviously you're going to see some hesitation because of profit taking and whatnot.
Well, yeah, I think that the demand for Bitcoin exists. There's still some reservations on part of institutional investors, I hear, meaning that they were very keen to get in early, like back last year in November and December. However, they're not that keen right now to buy this dip from what we see actually already over the if we look at a comparison with stocks, for example, because technically those are similar risk assets, so stocks and let's go with the Nasdaq. So you can see here that every drop, if you zoom out a little bit, every drop has been rather short-lived. We didn't have this month of consolidation at lower levels as we have with Bitcoin right now. So that's the only thing that kind of speaks to me that something is different in that market, and it's not like
so you're obviously comparing,
not acting the same way it used to act.
Right. So obviously you're comparing this consolidation after being down with these ones, right? Is that what you're trying to say?
Yeah, exactly. Yeah. It's different. Like we didn't have this. Obviously, like the fundamental news flow is whispering regulation, and basically that's what institutional investors are worried about. They had a field day in this market because it was unregulated. However, if it becomes regulated in some way, that's going to end the party.
I've just drawn the couple of levels here in terms of looking for support and the invalidation level. So right now that this blue line is the high of a couple of days ago. We broke above it yesterday. So for as long as we hold that level, I think the bulls will be happy. We could see a deeper correction back into this breakout area at 37,450. But anything below that would look a little bit worrying from a bullish point of view. And specifically, if we go now below this low, which was the last black or red candle before the breakout, should we go below that, then it would indicate to me very clearly that the breakout has trapped the bulls. So a move below 34,600 is going to be very bearish in my view, if it happens. What about the other coins? Ethereum, we look at quite regularly. It's doing okay. Still not out of the woods yet. It continues to remain inside a holding pattern. I mean, I can delete this. It's not. We don't need that trend line to tell us anything, because you can see quite clearly it's still inside this chop fest zone. I think it's a case of waiting for a breakout in the direct and then trading in the direction of the break. There's no point of
trying to guess the direction.
But there have been some tentative bullish signals. This was the first clear signal that we got. I moved below this low that failed to hold below, and since then, there's back into the high of this candle has been supported here, and here. So this area needs to hold now around this area. If we move below that, then I think it's going to be a bearish development. So that's the key support zone in this consolidation area that needs to hold. If we lose that, then we could retest the recent lows and the 200-day moving average. We didn't talk about gold and silver. They have come down a little bit, haven't they, in recent days?
Yeah, especially silver.
Yeah, I was quite bullish on silver. I still am, but price action is not showing me the bullish characteristics that I was expecting from silver. If you look at
there is still. I mean, that's another Fed play, another consolidation, before a potential move higher or lower. Again. We have said that we expect the Fed to be relatively dovish. That's not a given. Like they can switch the tune every minute, really. I don't know how much political pressure there is to rein in inflation. I'm sure that the Democrats are worried about rising inflation into the midterm elections that are due next year. So, they might exert some pressure on the quote independent Fed.
Yeah, that's a very interesting point. We shall see. If they are dovish, then there's no reason, in my view, why silver can't go higher from here.
Yeah. And the move above $30 should be rather violent, I would say.
Absolutely, yeah. And if you zoom out a little bit, this is the weekly chart.
You can see how much, how big of a breakout we had.
Yeah.
Moving outside of $20.
Yeah, in here.
So basically, yeah, if we
actually this is a really healthy consolidation, isn't it? If you think about it, in the grand scheme of things,
sure.
We had like a 6-year consolidation here. We broke out, big move. Now we have we're consolidating near the high of that big breakout, and so it's possibly gearing up for another push higher, possibly to challenge the all-time high that was hit in 2011 at just under 50. Remember that gold has already reached and surpassed its 2011 high. Can silver challenge its 2011 high? I think it can over time. Obviously, we're miles away from there, but the potential is there, and the weekly chart is looking constructive, albeit struggling at the moment. But I think it's going to break out, I think.
So I wanted to flag one commodity in particular that could be signaling something, and that is indeed copper. You hovered right above it. Copper has been a very good indicator of economic cycles.
Yeah. They call it Dr. Copper for no reason.
Yeah. Or for a reason.
For a reason, yeah. Sorry.
But yeah, the price of copper has been going up relentlessly since March 2020, and it has recently started to stumble. So this is part of obviously it's been an insane move that. Totally totally backed up by the fundamentals that we observe, because we have seen obviously the green energy push is very positive for copper, because conductors and all that machinery that is used in electrification of the economy relies heavily on copper as a base metal. So the lead up to this rally has been brisk, swift, and very telling about where we're going. But this breakdown candle today is asking some we should maybe start asking some questions. Whether perhaps the Fed is not correct this time around in calling inflation transitory. Who knows? Maybe they get it right this time around, and and the inflation moves back lower and lower as it has been doing in Japan over the past 30 years now. So let's see if this is something like another very big indicator are lumber futures, but I doubt that you have those.
I have.
Out. Oh, you do?
I do.
Oh yeah, LBS indeed.
LBS.
LBS. So yeah, lumber futures have been dropping significantly after
rising significantly.
We have the pyramid chart pattern. It's crazy. But for those of you that are keen in economics, like lumber and copper are just very good indicators of economic cycles, and right now they're both rolling over. And
I mean, with the case of lumber, it was more of a supply issue, right? That caused it to.
Yeah, sure.
Where's it gone?
Yeah, LBS.
LBS.
Yeah. But still, like, despite the violent moves, they remain relatively high when compared to last year. So,
indeed. Finally, crude oil is looking very interesting. It has broken resistance, continues to break resistance after resistance.
After resistance.
Which is telling you that it wants to go higher, really. Don't fight it until the charts tell you otherwise. I mean, fundamentally, we have been hesitant to remain bullish on oil at these levels because we think that the OPEC is going to start releasing more oil back into the market. Iran is coming back to produce oil, export more oil. And, obviously demand is strong at the moment, but that could be offset by increased supply from the OPEC and potentially non-OPEC as well from US shale producers. So while fundamentally I don't think this can go much further higher than it already has, technically, you can't argue with this. It's still pushing higher and higher. So we have been wrong on this. We say that it might break down when it was testing around 65 area, 67. It didn't. It went up. And same with crude oil. UK.
So next key level is all the way up towards 75 on
75 on Brent.
And
well, I think the gap has closed quite substantially between the two oil contracts. If you look at the spread, $2 now.
Nearly $2.
It has been as high as 10 to it got really crazy in there.
Let's
discount that because the WTI futures went into negative in the US. Around $10. It was where it was
previously.
Yeah.
Well, that's probably in part to the still relatively silent in terms of production shale oil producers. They're still not back into the market full swing, and we expect that to happen at some point. It has to happen because they own these assets and they have to pump out oil in order to make money. So at some point in time, obviously they're taking their time, waiting for prices to rise enough so they can come back into the market and start pushing prices lower again. So at some point it's going to happen. It's just that nobody knows when.
I'm just while you were talking there, I want to show you guys our YouTube channel. We are adding more content to our YouTube channel all the time. If you missed, obviously, if you're watching this webinar, you would have watched on YouTube the recording of it. But for those of you who have joined us live, we do post the recording of the webinar on our YouTube channel. But it's always better to join us live because you can ask us questions. And we've got a playlist for the webinars, so you can go there and view our previous webinars. We also have educational videos. We've got the key reversal pattern series, and we've got the failure of the key reversal pattern series. These are really educational if you are new to trading, or even if you're, if you have been trading for a while, you may find those videos quite useful. This is the failure of the key reversal pattern series. We've got at least 6 videos in this series. We're adding more and more content to our YouTube channel. So please make sure you watch those, especially during times like now when the markets are quiet, to get some real understanding of how price action evolves and how you could take advantage of technical patterns and so on. But for those of you who are unable to join us live this time, please make sure to join us live next time. So you can do that by going to our website at thinkmarkets.com and then go to market analysis. and click on live webinars. Here you will see a list of our upcoming webinars in the next month or so. We have one with Victor, the man himself, on the 1st of July. Make sure you join us for that. I think I will be there as well with Victor. He's going to talk about identifying key gold trends. So more of a macro kind of webinar, right? Than technical. Yeah. We have our usual live market analysis webinar. The next one is on the 22nd of June, at the same time as today, 11:30 London time. And then every first Friday of the month, we have the national payrolls webinar preview. And the next one is going to be on the 2nd of July, because that's the next, right there, because that's the first Friday of the month when the US jobs report is published. So you can register by click on the register button and then fill in your details, click on register, and then you'll be, that way you can join us live for those webinars. So thank you so much for those of you who are here today. And if you have any questions in the week, don't hesitate to get in touch with us through our social channels. But for those of you who couldn't be here, please join us live next time. And wish you all the best. Be careful out there. FOMC is going to be significant in terms of its market impact on the markets, and that's happening on Wednesday, as we mentioned earlier. So lots to look forward to then.
Stay safe. Make sure to not overextend yourself before these important news items.
Indeed. Okay, thank you so much for joining us, and we will see you next time. Take care now. Bye-bye.
Thank you. Bye-bye.